Forex Focus brought to you by IG. We have a really interesting developing story, not around data, not around central banks, but around price action. And we're going to bring our friend Paul Cappetta in on this one, as he's been around some of these Forex markets longer than anyone at IG and can tell you plenty about the Australian dollar, which we'll see if it's on the verge of collapse. We have a lot of interesting statistics to go over. But first, Paul, why don't you give us a rundown of this recent move? I mean, these are some real volatile swings in the last month for Aussie dollar versus US dollar.
Yes. Nice to see you again, Frank. But obviously, Aussie dollar is one. First off, it is a more volatile currency than the rest of them. It moves more. It's very fun to pay attention to. But it also has lots of correlations. So there's a couple things going on here, and it's kind of a snowball of all of them. The first thing I'll start with is China. The data out of China, I mean, they missed retail sales by 1.5%. That was kind of bad for that size of an economy. So you see that going on. You also see the correlation with gold. Gold's down off its highs from almost a 2,000 an ounce level back to, I believe, an ounce under 1,900. So you see that reflecting the Aussie dollar. The RBA has basically kind of said we're done with inflation now. So they don't seem to have rate hikes on the table. They seem a little bit more on a pause. So you're seeing that play through in the Aussie dollar. And then, I mean, we're at extremes, and you got a little bit of a risk-off attitude here where no one's really going to be buying Australian dollars in a risk-off scenario. It's dollars, Swiss franc, and it's normally yen, but yen's a whole nother thing, and we talked about that last week. But yeah, that's where we're at.
And great points there that all kind of feel separate in some ways, but all are kind of snowballing on each other, because you have, first off, the central bank in Australia pausing interest rates a couple of weeks ago when they were expected to hike. I mean, there was a period, and this is how quickly things swing for this Australian dollar. I mean, down 6% in a month, more than 400 pips in a month. You don't see that in a lot of Forex markets. Those are pretty volatile swings for a stock sector, let alone a currency market here. But that felt like a story in itself, the central bank pausing, and everyone's like, man, Australia, when we were at 69 cents up there and potentially getting back above 70, people were thinking Australia might hike rates past the U.S. in the next couple of months here. They pause. People start to question that. You start to get worse and worse data out of China, which Australia is very close to economically and obviously geographically. And it feels separate, but I'm guessing the central bankers saw the same stuff, which is like, man, if China takes a turn here, the gold market turns over, which gold is to Australia in a lot of ways what crude oil is to Canada, very closely tied to their economies. If those things turn over and we hike rates up above 5%, let's say, we might create a really tough environment for our economy here. So in hindsight now, maybe a smart move for the central bank to hold. But like you say, so well there, 3 or 4 things that are really causing some downside pressure on this Australian dollar, which the final point being the stock market globally has been risk off recently, and this currency, more than almost any currency, we'll get to some correlations in a second, is positively correlated with the stock market. But why don't you walk us through some of the historical prices here from IG, roping in more than 20 years here of prices, Australian dollar versus that US dollar. I mean, I'm not seeing a lot of price points below 60 cents. That looks like a pretty significant price level historically. And if we are seeing them, this is the monthly chart. I'm not seeing any monthly closes below 60 cents going back to 2002, 2003 range, Paul.
Yeah, so, I mean, yeah, you see the '08 move. It's a straight risk off, and it's an accelerated risk off move. And then you see the COVID move. The early 2000s move is, again, there's more to that as well. I mean, you have the .com kind of bubble and burst that also kind of played through in Australia. There's a huge boom in stock trading of miners in Australia during that time, which was kind of similar to the U.S., but it kind of also a boom there. So it's not surprising there. But I mean, we saw the carry on Aussie dollar basically evaporate at the beginning of this year, and now it seems to be turning around. So we'll see. That one's an interesting one to keep an eye on, those carry rates if you're holding positions overnight. But I mean, if it breaks 60, it's who knows where it could be. Basically.
Yeah. The interesting piece is you go back to those early aughts, and you do see a couple of months hanging around 50 cents there. Mm-hmm. So obviously more ground to potentially cover here. Of course, all of these markets are theoretical 50-50 on either side. But yeah, you eye that 60 there, and you can't help but see almost like like a hot stove, like touching it and then wanting nothing to do with it for more than a handful of days. And so this led me to be like, all right, well, let me borrow from our friends in futures some derivatives intel here and take a look at the futures options for Australian dollar and see what the chance of this 60 handle closing below that by the end of this year, start of 2024, by looking at the 60 strike puts expiring on Jan 5, 2024, currently showing a 14 delta, and that translates to about a 14% chance that this market closes below that level at that time. So essentially saying about a 1 standard deviation chance of a collapse in this currency when you talk about that 16 delta that options traders are constantly looking at and gauging, 16 delta a lot of times will be like, okay, that's what is kind of feasible. When you start to get into single digit deltas, it's like, that is, maybe not so possible. But they're thinking that a collapse down to 60 cents here is relatively possible.
Yeah. I mean, that's another, 7-8% move further from here. So that could get aggressive. That could happen relatively quickly. But that's interesting that the options market's already starting to price in this. Obviously, you're pricing in central banks, you're pricing in what's happening in China, you're pricing in gold all simultaneously. So that's an interesting chart there. I didn't know that delta was that high for another 7% move down.
Really, it's funny because it's been, like we led the show, 7% here in August of Australian dollar moving lower here. And we talk about how that's such a crazy move, essentially looking at lightning striking twice by the end of the year. And it hasn't been like 100 pip days in Australian dollar. Like, oh man, like we look at our platform in the morning as like Australian dollar lost 150 pips last night. No, it's like 30, 40, 50 pips like today. And slowly those options traders have started to price in a greater likelihood. And just for all of the option theory heads out there, with a 14% chance, or a 14 delta that is, that's the probability of this market closing below that level by Jan 5, 2024. The probability of it touching that level is roughly twice that. So they're looking at roughly a 30% chance that we touch 60 cents at some point in the next 4 or 5 months. So really getting kind of crazy in this market. And I'm glad you brought up the Chinese piece there, because you would be crazy to call this coincidence that you're seeing worse and worse Chinese data come out over the last couple of weeks and Australian dollar driving through these lows. And so I put the numbers together, and you have a correlation, Paul, positive 0.7 between Chinese stocks and Australian dollar. I mean, you'd be hard pressed to get a correlation between any stock and a forex market of positive or negative 0.2, 0.3. That's why a lot of people go to forex, is for the diversification it lends you relative to stocks. I mean, this is pretty highly correlated here between China and the Australian dollar, and then you mix in the price action of Chinese stocks. I showed you this earlier, and this is pretty surprising, mixing the Chinese stock ETF relative to the S&P, right?
Yes, definitely. I mean, usually they're pretty correlated economies. It's kind of a disjointed story there. I mean, Japan had great GDP. China doesn't seem to be doing all that well. There's obviously different dynamics, different political dynamics going on in those two countries, but it's interesting to see, and it's playing through into, basically Australia right now. Where else it's going to play through, we'll see. Obviously, these kind of international economies are all interconnected. No matter how much we want to kind of fight that, we're always going to be interconnected, just given the scale of the world. So It'll be interesting to watch moving forward. we'll see what happens on the U.S. front, but it's an interesting story, and it's developing every day kind of deal.
Yeah, and this is part of the like Australian dollar devaluing relative to a lot of currencies, but in particular that U.S. dollar as the U.S. economy outperforming China and Japan and a lot of these other places. But yeah, this is pretty staggering stuff. You know, almost 30% outperformance the S&P versus Chinese stocks this year, not in terms of the last couple of years, the year to date. And as the last piece here, looking at the client sentiment around this pair, a lot of traders taking the contrarian view. More than 4 out of 5 traders at IG with positions in this market are long the Australian dollar, short the US dollar, looking for that bounce. Again, you know, market can go wherever, theoretical 50-50 from here, but 82% long. We don't see these very often, Paul.
No, this is extreme. I mean, this is, people are looking for the bounce. They think it's going to happen. There's an old adage, don't catch the falling knife, but you never know. You never know. It could go, I mean, either way here. We're at extremes, so it's not uncommon that forex moves bounce back the other way, or they can continue. I mean, we saw the yen did what it did last year. This kind of reminds me of that, but it also could be a different story entirely. So you never really know, but I mean, everyone's playing extremes. There's interest in this market right now, so
yeah,
it's a fun market to watch.
Yeah, just make sure you're watching that risk because, yeah, it can bounce back at any time from 64, 63, wherever. And that bounce back can be very volatile for those riding the trend as well. So a lot of stuff to look at. Thanks as always, Paul, for joining us here on the Forex Focus segment.